6 out of 10 people are not saving as much as they would like for their future, and a strong majority of Americans surveyed as they're approaching retirement, they're more concerned about running out of money than they are about dying. That's sad. This is the biggest problem I see as people are preparing for retirement. Whether they use the infinite banking concept or not, it's just that they're not saving enough. So how much are you saving? We recommend our clients save at least 10% of everything that they're making after taxes. Some advisors tell clients to save a minimum of 15%. And just to give you an idea, the average American millionaire is saving about 23% of their income, while the top wealthy 1% are saving over 30% of their income. We use the 10-20-70 principle, which can help you get to the Millionaire Savings Club. So you have your total 100% of your income, 10% is the minimum amount that you want to keep, 20% is the maximum that you want to be sending toward debt payments on things like credit cards, personal lines of credit, 70% is your income for living expenses. That can include a mortgage payment, some student loans, some of those long-term debt that are directly related to living expenses. So once you have your personal creditors paid off, the credit cards and the personal lines of credit, now you have 30% of your income that can be yours to keep, no problem. It gets you right to the Millionaire Savings Club. Now, many of our clients use whole life insurance policies and the infinite banking concept during their lives to recover interest, finance business ventures, avoid lost opportunity. And life insurance cash values, they can also be used in retirement. So I want to share some of the ways that we help our clients with this process. First, I'd like to share a little bit about the perspective that we approach retirement from. If you have read my dad's book, Winning Your Financial Game, you know that building your life and legacy tends to be a better focus than just focusing on retirement. And just focusing on retirement, it's not usually an ideal goal. I really like Rabbi Lapin's analogy for the game of golf. If all of your attention goes to the moment that you hit the ball and you don't pay any attention to your follow through, then your ball is probably not going where you want it to go. And the same thing is true for retirement. If your focus is all on the moment that you're working up to in retirement, then you're probably going to be disappointed in life after retirement. It's interesting to note that the Hebrew word for work is the same word as the word for worship in the Hebrew language. It's this word right here, avodah. Now, in English, when we have a word that's used for multiple things, take the word lead, for example. You can have somebody that leads a company. You can have a lead on a case. We can also have the metal lead, which is spelled the same way, even though it sounds differently. There's not any connection between these words. Same thing with I can have a bow and arrow, or I can tie a bow with a ribbon. Those things don't have any intrinsic connection, but in Hebrew, when the same word is used for different concepts, those concepts have an intrinsic connection. It's interesting. If we look back at biblical history, in Numbers 8, you have the Levitical priests that were to perform services in the tent of meeting from age 25 until 50 when they were to retire. But then they were going home to their villages to teach their neighbors and their family about following God. In Luke 12, we have a parable of the rich man who was going to tear down his barns and build bigger ones. And that was definitely seen as a negative portrayal since he wanted to heap it all up on himself. These are the closest references we have to the concept of retirement in the Bible. Otherwise, we don't find it anywhere, really nowhere in history up until Bismarck in Germany, when he noticed that a lot of his political enemies were age 65 and older, and he decided to pass a law so he could retire them all and get them out of his way. So retirement is not necessarily a positive concept, but many people, they want to retire in American culture because they don't enjoy what they're doing at their job. Well, maybe there's a way that they can build something that they do enjoy doing. And even people who enjoy doing what they're doing, maybe they don't want to work as long or as hard as they do at what they're doing right now. Maybe they want to do something different. So you can want to see a progression in your life, and rightfully so. But I just want to clarify the way that we're thinking about retirement is in this context, rather than the way that many Americans think about retirement, where it's just stopping work so you can do whatever you want to do, basically kick back and relax. You want to see progression in your life. You want a cash cushion. You want to build a financial resource that can allow you to do that. So our concept of retirement is going to be close to what Solomon recommends in the book of Ecclesiastes, where he says, "Here's what I've seen to be good and fitting, to eat, to drink, and to enjoy oneself in all one's labor, which he toils under the sun during the years of his life, which God has given him, for this is his reward." Now, when people are using life insurance as a financial tool, using the infinite banking concept during their lifetime, now they're getting closer to retirement, and they're thinking about it, and some common questions that come up are, do you need to keep paying the premiums? So whole life insurance is built upon premiums that are for your whole life. So that can be, sometimes they're shortened to like age 100 or age 75, but can you stop those early? That's an important question. And how do you convert the cash value into income? People that are using the infinite banking concept are familiar with taking policy loans, paying that back with interest. They see the cash values grow as they're saving for the future and as they're recovering interest on the things that they finance in their life. But then how do you get the money out? People are familiar with a bank account. You put money in, you can take it back out. They're familiar with an investment account where you could sell the investments and then take the money from those investments out. How does it work with the life insurance cash value? There is a way to do it. And there is a way to do it without having the interest on the policy loans. We'll talk about that. Another question, which assets do you pull from? Some people have money in life insurance cash values and they have money in other investments. There can be some strategy involved on which assets to draw from. And finally, a question on how much you can afford to draw. The last two questions can be very specific to each person's situation. We'll go through some examples, but the first two we can answer very easily conceptually. So when we're talking about life insurance policies and the options that you have as you're approaching retirement, you can keep a policy as it is. And with this in mind, as you're approaching retirement, you usually want to be thinking about repaying the policy loans. As you get closer to retirement, you're basically building up your savings as you get closer to that next milestone. You can choose to continue the premiums once you get to retirement. Some people who have small policies and they're wanting to maximize their death benefit and the legacy that they're leaving to their children, this is a great option for them. Some people want to stop the premiums. So we can do that in a couple of ways. There's something called a premium offset, where you can take a withdrawal from the policy. So a withdrawal is different from a policy loan. When you take a policy loan, there's interest. When you take a withdrawal, it's a permanent withdrawal, and it reduces the size of the policy. So we're taking a withdrawal to pay the premium. So paying the premium increases the size of the policy again. So that's called a premium offset because the withdrawal is offsetting the premium that we're paying there. Another way that we can stop the premium is we can reduce the death benefit so that no further premiums are required. This is called a reduced paid up conversion. Sometimes it's called an RPU. And then as far as getting income from the policy, we can take withdrawals for income, and we can withdraw everything that we've paid in premiums for a policy tax-free. If we withdraw more than what we've paid in premiums, then the growth is still taxable because it's during our lifetime. So we could do a combination of policy withdrawals and loans for income, or we could also look at doing 1035 exchange of the life insurance cash value to an annuity, which pays a guaranteed income either for a certain amount of time, for our lifetime, or some combination of those options. So let's take a look at what this might look like. Here are the premiums on a policy that would be designed for infinite banking. This is a 40-year-old paying a $50,000 premium for 10 years, and then it drops to just the base premium. So they pay about $21,000 a year out until age 75. This policy is designed to be paid up naturally at age 75. If we wanted to stop the premiums early on this policy, let's say at age 65, we can do that. That would be represented with the blue lines that you see here. And then for the next 10 years, between age 65 and 75, what's happening behind the scenes is we're taking a withdrawal to continue paying the premium out through age 75. Now, our net out-of-pocket outlay with this method, we got about $820,000 that we paid instead of a little over $1 million that was paid on this policy. And here are the values on this. The cash value is in the darker color, the dark orange, and the light orange represents the death benefit. This is on the policy where we paid the premiums to 75. And the blue option then is the premium offset method. So with those withdrawals, we can see we paid about $200,000 less. Our cash values, if we're looking at age 90, are about $600,000 less, but it still grew very well. Now, something else that we can do, this is the premium offset, where the premium is stopping at 65. What if we did the reduced paid up, where we lowered the death benefit so that the policy would be paid up and no further premiums are required? This is now the green lines that you see here. Same outlay, $820,000. So let's take a look at the values. Here was the premium offset values. Cash value is a little bit better on the reduced paid up method. Starts out very close. Those lines are almost right on top of each other, and it grows to be about another $160,000 by the time we get to age 90. And then the death benefit, right here, this inflection point, that's where we did the reduced paid up conversion. So we reduced the death benefit. It actually ended up with the death benefit being higher in the long run by doing it this way. Sometimes there are reasons that we would do a premium offset rather than doing a reduced paid up, but these are options that are available to stop the premiums. Now, how do we get income from this? Well, we could take withdrawals. We could withdraw everything that's been paid in premiums. Let's say we start $80,000 a year withdrawals at age 65. That means we could take those withdrawals all the way almost till 75, That last year is a little bit shorter there because now we've taken out everything that we can take out tax-free. So we would need to switch to policy loans or another option at this point if we wanted to continue the income. So if we switch to policy loans, that's shown in the light green now, but now we start having some interest on those policy loans. We could do that out till about age 97, 98. We would be able to take about $2.6 million according to the projections for this policy. Okay, but here are the policy values. So this is the cash value. It grows until we start taking the withdrawals. And then as we start taking the policy loans, it starts decreasing faster and faster. It doesn't just go in a straight line like we see here. It decreases faster and faster until it hits that 0 mark because of the interest that's accumulating on the policy loans. So here's what's happening to the death benefit during the same time. And right about here, we would need to be watching this because this could create a taxable event if we're not careful. Now, there is an alternative that's in the yellow lines here. What if we go ahead and pay the premiums up until age 65, and then we take withdrawals from the policy? We stop the premiums, take withdrawals to for income purposes, that $80,000 a year, until we've taken everything out that we paid in premiums. And then let's say we transfer the policy to an annuity. So that's why the policy values drop right at age 75. We take away, the policy goes away. Now we have an annuity to create income. So here's what the withdrawals would look like, the tax-free withdrawals. And then here's the annuity income that kicks in. And this looks a lot better. So in this way, using the tax-free withdrawals and the annuity, we're able to get about $4.4 to almost $4.5 million of income over this lifetime. Now, maybe we don't live all the way to age 110 like this graph goes to, but even so, this has given us quite a bit of a higher income level than just the withdrawals and policy loans. We could also look at an example, well, the annuity works so well for income purposes. What if we did it at 65 instead of waiting until 75? And that would be the purple lines here, where we pay the premiums on the policy up till 65, and it cashes in, goes to the annuity at this point. Here's the annuity income here. We do get a little bit more income out of this, but maybe not as many options. So for example, let's say we wanted to access some of the cash value along the way. Once we roll to the annuity, that's not an option. We're getting the income from the annuity. That's the option we've chosen. So this is where it can be valuable to have multiple policies. Maybe you roll one to an annuity for the income, you keep the other one so it continues growing, can provide a tax-free legacy if you don't use it. But if you need to use it for things like long-term care or to finance other things that come up in retirement, you have the option to do that. One question that may come up with this type of annuity is, well, what happened to the tax-free withdrawals? So what happens here is part of the annuity income would be tax-free, the part that you see in the darker color here, while the other part would be taxable. Another way that life insurance cash values can be used in retirement is as a buffer for other accounts that are invested. So the life insurance cash values are not invested. We know those are going up every year. But what if somebody has their life insurance policy and their cash values are growing and they also have an investment account? Having life insurance cash values as well can give them more options when things don't go as planned with the investments. And here's how that might work. Let's say you have a $100,000 investment, you don't have life insurance. Year one, you lose 20%. Well, you're retired, so you need to pull income from this. So let's say you need to withdraw $10,000 from this account. So your account was at $100,000. It came down to $80,000. Now you have to take another $10,000 out, so you end the year at only $70,000 in your account balance. Well, next year, the market comes back, so it gains 25%. This would have put you, if you hadn't taken the $10,000 withdrawal, it would have put you back at $100,000. But instead, when you withdraw, you've got to withdraw another $10,000 this year. So you're going to end the year with $77,500. With life insurance, you can do this differently. Let's say you start with a $100,000 investment, but you also have your life insurance cash values as a reserve. Year one, the investment account loses 20%. Well, you say, I'm not going to take the $10,000 I need for income from the investment account this year. Instead, I'm going to take it from the whole life insurance policy. We're going to give the investment account a chance to bounce back. So you end the year at $80,000 in the investment account. Then year two, the market gains 25%, and you withdraw $20,000 to catch up for the year that you had skipped. You could even use that to pay back some of the policy loan if you wanted to. Okay, you end the year at $80,000 in the investment account. So that means you saved $2,500, that you have 3% more than if you did not have the life insurance as a buffer. Another way life insurance can help with an investment strategy, let's say that your overall risk tolerance is about a 50-50 allocation. This typically refers to how much of a portfolio is in stocks versus in bonds and cash and other types of more stable investments. You could expect potentially a 4 to 5% return on this portfolio. Let's say that you have $450,000 in whole life insurance cash values and you have $780,000 in invested accounts. Well, because you have the life insurance cash values, which are 100% stable and liquid, they're not going up and down with the market, and you have your $780,000 that is invested can actually be invested a little bit more aggressively and still keep you in balance overall. So maybe instead of a 50-50 portfolio, you could be 80-20. And if you were able to do that, then maybe you could expect a 7 to 8% potential return on the money that you did have invested. That could look something similar to what the graph that we have on the right. You can see that stocks and business interests is still about 50% of the portfolio, while life insurance cash values are helping to make up the other 50%. Another way that life insurance can be used in retirement is the death benefit. A lot of people, a lot of advisors, in fact, say that you're not going to need a death benefit when you get to retirement. I understand where they're coming from, because if you've saved enough assets and you're living on those assets and one spouse dies, well, the other spouse can just continue living on the assets that you had saved up. So I get it from that perspective, but the death benefit can still be a tool. Obviously, it can be a legacy as well. Some people want to leave a legacy, some people don't. But the death benefit can also be a tool to give you more options for income planning. Here's an example of how that can work. We have Jake and Molly. They have $1.4 million of whole life insurance cash values, split up between a few different policies. Jake has some cash value, Molly has some cash value. Here's the death benefit on each of them. And as they're getting closer to retirement, let's say Jake doesn't need this $1.9 million of death benefit anymore. So what can we do with it? Well, we could potentially take one of Jake's policies and do a $460,000 tax-free withdrawal to pull income out of that policy. And then we could roll the part that would be taxable if he took it out. We could put that into an annuity, $220,000. And now he gets income from the annuity. The income from the annuity is going to be taxable as well, but it helps to stretch that out over time instead of taking the tax hit all in one year. It also increases the income that he gets. There's just one problem with this. If the $220,000 goes into an annuity that pays out for Jake's lifetime, and Jake dies shortly thereafter, well, then Molly doesn't get the maximum income that she might have received if Jake had continued living. Now, we could put Molly on as a joint annuitant, so it continues paying out for her lifetime as well, but then that's going to cut the amount of income the annuity is going to pay, because the chance of Jake and Molly living a long time is more than the chance, just based on Jake's life expectancy. So what do? Let's take the $220,000 that's going to the annuity. If we move over here, $1,450 a month can be paid out if it's based on Jake's life only. Molly is significantly younger, so it's only going to pay out $800 a month if it's based on Jake and Molly's lifetime. Well, they can go ahead and take the annuity based only on Jake's lifetime, because here's what's happening. Jake has this cash value and death benefit over here. If we look at the difference between the cash value and the death benefit, it's $220,000. So if Jake passes early, his death benefit is going to allow Molly to get the extra $220,000 that went to the annuity. It'll allow her to recover that indirectly. Now, there are some points that we want to consider when we're using life insurance for preparing for retirement. That is, you usually want your policies to be 10 to 15 years old before stopping the premiums on them. You don't usually want to make major changes within 7 years of wanting to stop the premiums. For example, if you make an extra premium payment beyond the scheduled premiums, and then you want to stop the premiums within 7 years, you might not be able to without causing the policy to become a modified endowment contract. It means it would be taxed differently. That's usually something you want to avoid. And then it's usually best to have a policy be at least 15 to 30 years old before you start taking withdrawals or policy loans that you don't plan to pay back, or before you exchange it to an annuity for income. Now, not always is this the case, but that's a rule of thumb that tends to allow the policy to grow, so we get a great return out of that before we roll it to an annuity for income purposes. Something you want to think about as you're building assets for your future is, where are you keeping those assets? I've seen that life insurance is still balanced when it's about 50% of somebody's portfolio. I've seen less than that be a balance, as in this case here. We have the life insurance cash values are making up part of a portfolio that looks pretty balanced as someone is approaching retirement. The portfolio on the right here has more in real estate. The stocks and bonds aspects looks fairly balanced over there, but they don't have very much cash values in their life insurance policies. So I'd like to see cash values be a little bit bigger slice of that portfolio if someone was close to retirement. Of course, if someone has just started their policies, then they may have a smaller slice than people that have had their policies for several years. Something else to consider is, what type of tax treatment are your assets experiencing? There are taxable accounts like bank accounts and brokerages. There are tax-deferred accounts like 401ks and IRAs. That's where the money it does not get taxed going in, but everything coming out is taxed. And you can't take it out before 59.5 without a 10% penalty or under special circumstances. There are tax-free accounts like a Roth IRA, where the money going in is taxed, but then the money coming out after 59.5 is not taxed. It's tax-free. And then there's life insurance. Life insurance is kind of a hybrid between these. It's very much like a Roth IRA in that the money going in is taxed, and if the death benefit is paid out, then the life insurance death benefit is income tax-free. So that's very much like a Roth IRA. If you're going to access life insurance during your lifetime for retirement purposes, then you could take back all your contributions tax-free, kind of similar to a Roth. And if you take withdrawals, or if you roll to an annuity that you're taking the income during your lifetime, then that's going to act more like the tax-deferred account. The extra growth in the whole life insurance policy, as you take that, that would be taxable. Obviously, focusing on your savings, making sure you're putting enough away on the front end, 10 to 30% of your income, is a good place to focus. But if you're looking at it from an asset level, like how much money do you need to create a certain income stream? Can be a helpful way to look at it. A sustainable withdrawal rate used to be about 4%, which means that if you had, you wanted an income of $40,000, then you would need $1 million of assets to back that up, like this screen shows right here. There has been some more recent research that as people are living longer, as market returns are less, then you might need a lower withdrawal rate. So in this case, one study cited 2.12%. So in that case, you'd want an income stream of about $40,000 to be backed up with about $1.9 million of assets. Different people's situations are different, but somewhere within this range is usually what I find to be about right. Annuity rates can be higher than the sustainable withdrawal rates that we just looked at overall, but of course they cut down on your options as well. So an annuity can be a good tool for producing an income stream with a certain set of assets once you know that that's what you need. But it can depend on interest rates at the time you start as well. I ran some examples in 2020 when interest rates were lower. I also ran some in 2025, and I have these examples as a reference. So starting an annuity at age 70 back in 2020, the payout rate was about 5.22%. And here more recently, with interest rates being up, it's closer to 7%. So if you had put $100,000 either from life insurance cash values or other assets toward a single premium immediate annuity, you could expect a payout rate of close to $7,000 this year. Back in 2020, that would have been a little bit less, about around $5,200. If we look at an annuity at 75, then the payout rates go up. The older you get, the payout rates go up. Again, you can see what that range would have been from 2020 to 2025, and then again for somebody at age 80. So this is why annuities can be good planning tool for income purposes as you get close or are even in retirement. There are annuities that are deferred annuities, and the insurance company can change a lot more factors with those types of annuities. These annuities that we're looking at right now are simply for converting a lump sum of assets into an income stream. The takeaway is that life insurance allows you to have more options and less risk as you're preparing for the future and for retirement. It can allow more spending in early retirement. It can allow a wider range for investment strategy, and it can help you to multiply your legacy. Our clients who use the infinite banking concept in their retirement are not as worried about the stock market. They're not as worried about taxes. Even if they have taxable assets like a 401k, having their life insurance too allows them to have a balanced approach to the way that they take their income. And our clients who are using this are less worried about running out of money, which can translate to more quality time with family, traveling, or doing the other things that they want to do.